Alrighty, folks. Earnings season starts to kick off in earnest next week. A lot of the banks have reported, regional banks particularly weak, things that we talked about with Mr. Dan Bird. But next week we got the big tech, we've got credit card companies, we've got Hilton, lots of stuff going on in the economy. We have a House of Representatives that doesn't have a leader. We have UAW strikes still going on. There's all kinds of stuff, not to mention what's going on in the Middle East and Ukraine. Wow.
And the market's crashing.
And the market's crashing. What else could be going on? So talk to us, man. What happened last week? And let's set up next week.
Well, Tesla reported too.
Oh, that's right. Yeah.
Interestingly, Tesla and Netflix both reported last week.
Same day.
And
yep.
I was watching a webinar by Tom Bowley where he was kind of comparing earnings season coming up.
Yeah.
And looking at what he typically looks at. And what he said was, I expect Netflix to be terrible and Tesla to be great.
Oh, whoops. Swing and a miss twice.
Complete opposite.
Tom, you missed that one, buddy.
Yeah.
It happens.
Complete opposite. Tesla affects the consumer discretionary sector also.
Yeah, down 15%, I think.
Yeah, I'll show what the Tesla effect looks like on that sector.
Yeah,
but yeah, not a good week. It's very much different than a week ago when we talked.
Yeah, but I remember if people go back to the playlist, you were pretty adamant that we are at an inflection point and it could go either way.
Yes, and also that we still had 2 weeks left in the worst time of the year.
Right, and we have one more week. So
and we have we have one more week. Actually, the worst week next week.
Great. Oh, great. The worst week.
And the worst day is Wednesday.
So wait, we have the worst week and the worst day
is Wednesday
for the year, just ahead
for the whole year.
Oh, great.
So
all right,
we may be going down some more.
Sounds like it.
So you want to look at some charts?
Yeah, let's look at some charts. Now that I'm fully depressed.
You don't have to be depressed.
I'm not depressed. I have almost nothing in the market, so it doesn't really affect me. But
yeah, and if you did, you had your stops in, right?
Exactly.
I'm pretty much out of everything. So, well, first of all, let me see how I'm going to do this. If anybody's interested in getting my newsletter or actually communicating with me, just go to breakpointtrading.net. I've had quite a few people, especially recently, and that typically happens when the market starts looking like it's crashing.
Yep.
And all the crash bros out there start talking about, I told you so, and now it's happening, and here we go.
Yep.
And so I've had some people just send me emails saying, what do you think about this, and what do you think about that? And here's an article I just read. What do you think?
Yep.
And I'm happy to have those kind of conversations. In fact, it's constructive to have those kind of conversations, so you can get both sides of the story, basically.
Absolutely.
And then make a decision. It's not to say either one is right or wrong. It's just gathering information so you can make a decision. So breakpointtrading.net, that's the website, and we'll be using that today as well. You can get the free newsletter there. I made a point, so this is what the email now that goes out. It says Breakpoint free weekly newsletter. And I made a point, I'm probably going to take the free off next week, because one person sent me a note saying, why are you highlighting free? I already know it's free.
And in fairness, you don't have a paid option. So
no, it's not paid. That part of it's not paid. There's no credit card asked for. Nope, you don't even need to register your email now. You can just go click on it.
Yeah. Nice.
Read it. So
cool.
But I'll probably take that off next week. So anyway, that's where you can get it right there, breakpointtrading.net. So let's first look at some historical trends. This is from Stock Traders Almanac. We are right here, this black line.
Mm-hmm.
So 1023 is tomorrow. You can see the dash lines are the pre-election year trends going back to 1950. And this is why I said it's the worst week, and the worst day is Wednesday. Right there. But then it starts going up after that. And then the next one, they've posted November's trend as well. So November kind of goes sideways until the end, and then it starts really taking off for the end of the year rally. Now, this is historical trends going back to 1950. That doesn't mean it has to happen again, right? So it's an average trend of all these years. So there can always be anomalies, but it's always good to know what the historical trends in anything are.
Sure.
See? By the way, in the second session today, we'll talk about some of that. We're going to talk about the 2008 housing crisis and what caused it in the second session, just to let everybody know what the second one's going to be about.
Yep.
So anyway, that's what the trends look like. Let's go look at the chart. Go to the website. This is the website here. First thing you'll notice is the IBD status has changed again. Last week it said uptrend under pressure.
Right.
Now it says market in correction. This is as of Friday. So with a down arrow.
Okay.
Keep exposure to 0 to 20%. And these little charts right here are on the front page, so there's no subscription needed for that. By the way, the newsletter, just click on this box and you get the newsletter. If we look at the S&P, and I usually keep these annotated so you can see where the levels are. A couple of things to notice. First of all, the last 3 days, last week, Friday, Thursday, and Wednesday, all big red candles.
Yeah.
Every day was just
closing near the bottom. Yeah.
Closing near the bottom almost every day, and definitely near the bottom on Friday. In fact, I think it was at the bottom on Friday.
Wow.
Back to, let me see. The low was 42.23 and the close was 42.24. So it was within $1.
Yeah.
So last week I said, we've still got some selling probably. We hit the 50-day and got rejected right there, started down and broke through this first level. The 8-day moving average never went above the 21. So it started moving back down again. This pink line goes all the way back to last October. So that was the trend from last October. Broke through that. Broke through the 50% Fibonacci level. And I said last week that the next support should be the 200-day moving average, and we actually closed below it on Friday. So none of that is a good thing.
Yeah, none of that's good.
None of that
the 200-day. Oh wow.
Yeah, just barely, but yeah, we closed below the 200-day on Friday. 200-day was at 42.33, and we closed at 42.24. So 9 points. The next level is this dashed blue line right here is the channel that we're in. That goes back to August. See, every time it goes up and hits that, the channel, this line was created when this first one started going down. And then this channel has been there since then. So it went up and hit it, came back down, never got back to it, didn't even get above the 50-day. Went down and hit it down here. Actually, what I did was I just took this upper line and just took an exact copy of it and just moved it down to where this low was. So that's the bottom of the channel, which also coincides with the next Fibonacci level, 41.75, which also coincides with this critical support level, right, going back here to April and May, which is right around the same area, 41.70. So somewhere in that general range. These things will never be exact. So just take the general range, anywhere from 41.50 to 41.75, somewhere in that area. That's where we need to see support.
Now, let me ask you a question about Monday at the open. Given that we were selling into the close Friday, does that project that there may be some follow through and more selling, or is it the weekend clears everything up? What is there?
No, it probably means anytime you close at the low or right almost exactly at the low, that often means that the next day or Monday will be additional selling. There's something else that I'll show you here in a second that might cause that as well. But yeah, there could be additional selling. Now, I always like to look at similarities going back in the chart. So we've got 3 red down days right here. So let's go back and look. We have 3 right here. three in a row, opened lower the next day, and then started trading up.
Right.
And that created the bottom on that one. Got three red down days right here. There's actually a gap on that one. Then we had a little rally, small rally, and then it continued down for 2 more days. Rallied a little bit and went back down again. All right. So I think we may probably sell off Monday, but we may come back by the end of the day. That's actually what I'll be looking for.
Okay.
This isn't quite capitulation, but look at the volume down here.
Yeah, I noticed
Each
that.
of the last 4 days. On each of these selling days.
The VIX broke 20, right?
Yeah, that's what we're going to talk about next.
Oh, there you go. Look at that.
Yep. So the volume is increasing. If we get a big, huge down day at the open on huge volume at the open, and then we get a reversal and end up with a hammer. Here's a little hammer right here, this black one. If you look over here, this was basically 3 down days and ended with a hammer right there. This one here this is a good one. There's 3 red candles right here with a kind of a hammer, you know, the little handle at the bottom. And then after that, it started going back up. So if that happens and we get huge volume, that could be capitulation. Okay. On Monday. But it might not happen Monday. I mean, it could be anytime next week. The whole week is still a pretty bad week. Yeah, it's not until October ends and all of the big mutual funds and hedge funds and, you know, they all have to rebalance everything. Right. They're required to at the end of October. And then they position themselves for the end of the year. Right. So that's, you know, in November, end of October into November is when that starts happening. So this might not be Monday. This could, you know, continue down. It could be 3 or 4 more days. Sure. Of this. Okay. So not looking good, basically. So yeah, the VIX, very important. Here's the VIX up here. Here's the 20 line. Yep. You know, if the VIX is above 20, get out of the long side. So anytime that happens, typically what happens when it first goes above 20 is market makers will step back and they won't support the market. They will just let the selling happen. So the VIX, what does the VIX mean? The VIX is called the volatility index, but it basically is taking the options market and looking at volatility on options. Right. And volatility normally spikes, goes up when there's a lot of option buying, usually to the downside. Downsides happen very quick. You usually have a panic selling. You very rarely ever hear about panic buying, right? Things go up a lot more smoothly and orderly than they do going down. Yeah, I've always called it the elevator down and stairs up. Yeah, exactly. So that's what the VIX represents. Represents increased volatility in the options market. And when this gets above 20, that's when a lot of times market makers will just step back and not support the selling or not take the other side yet. They'll wait, which exacerbates it. And that's when you know, bottoms a lot of times happen. But it's just gone above 20 the last 2 days. It went above 20. So it hasn't been there for a sustained period yet, but it's still definitely a warning sign. By the way, if we go back, one more thing on this S&P chart. Something that I'll be looking for, if we do get this down day on Monday, and then we do start to see some buying stepping back in, what that's going to do is it's going to turn this RSI back up, and it's going to turn this momentum indicator right here. This is the MACD. It will turn that back up as well. If both of those things happen when the price goes lower, so right now it's already lower than this low back here in the beginning of October. Right. But if the price goes lower and these do not make a new low, if they don't get down to the same lows that they were before, okay, and they start to move back up, that is a bullish divergence. That means the downtrend is running out of steam. Okay. So that's what I'm going to be looking for if we do get
Awesome.
any kind of buying coming in. I want to see if these don't make a new low, don't go
Now,
back down.
do you think that I don't know how quickly these charts change. Do you think that will be something we might be able to see next week, or might it take
Yeah.
more time than that?
Oh
Okay.
no, you'll see it as soon as any kind of uptrend happens, you'll see it.
Okay.
These are daily charts, so by the close of the day, Monday,
Right.
if we get some buying coming in on Monday, then these will start to move
Okay.
up.
Cool.
So, but that's the thing. I always look for divergences. They're very powerful.
Right.
Okay, so the VIX is there. Here's the S&P down here. This is the 10-day put call ratio. Interestingly, the put call ratio spiked up right here. And then it started to trend down, which means there were fewer puts, even as the VIX was trending up. That was kind of curious, actually, to me. Now, it's still very elevated. Above 0.75 is that means there's a lot more puts. But whenever you get a lot of puts out here, then that's the time when the market usually reverses.
Okay.
The other thing to look at, and this is all on the VIX chart that's on the website, is the percentage of stocks above their 20-day and 200 or 50-day and 200-day moving averages. So you can see right here, especially the 50-day moving average. So you see where it got down here to 10%.
Yes.
So it's the S&P 500. That means there were only 50 stocks out of 500 that were above their 50-day moving average.
Wow.
All right. Right now it's at 15%. Whenever it gets down here this low, actually anything below 20, really. You can look way back here. It just barely went below 20 right here. And this was in March when we had the sell-off in March, and that marked the bottom right there. This one marked the short-term bottom back here, beginning of October, when we had a little rally. We're not quite that low yet, but we're at 15%. And we're actually at, on Thursday, we were at 19%. So in one day, it went down 4%. So it could easily get down to 10% on Monday.
Sure.
So that's another thing to look for a bottom or for a rally, is when the percentage of stocks below their 50-day gets way down there. And then, of course, the 10-year Treasury, which has been causing a lot of this.
Sure.
As you know, you can see how it spiked to 5% right there. Pulled back a little bit on Friday, but we'll have to see if that pullback continues or not. We'll see. The other thing I want to show is, first of all, the Keltner charts. This kind of gives you the extreme levels. And last week when we talked, and I think I showed this one last week, I said, we're still in the middle.
Right.
We're still at the reversion to the mean. So if it's going to start selling off, there's still a long way to go.
Right.
But now it's down here near the third ATR level, average true range. So especially when this lighter band right here is so wide as that, you can look back here when it was wide, got down into that third ATR, just barely touched it back here when it was wide. If it gets down into here, I think that's going to cause a reversal back to the mean.
And really what you're pointing at is you just think the selling is just going to exhaust itself.
Yeah, the selling will exhaust itself at some point. There's no question that will happen.
Okay.
The question then is, when will it happen? And then what does it mean? Will it just go back to the mean and then reverse and go lower? We don't know that yet. But I think sometime next week, the selling will exhaust itself, and we're going to get a bounce.
Okay.
At that point, we just have to figure out, see how much of a bounce it's going to be.
Okay.
And whether it's the beginning of the end of your rally. Now, one thing I added this week are these high-low charts, which are kind of interesting. If we let's look at the NASDAQ. This shows you the new highs minus the new lows.
Oh, look at that.
All right. So you can see how many, there are much fewer new highs than there were new lows, which turns this to red. Or another way to think of it is there are a lot more new lows than there were new highs.
Correct.
Right. This is for the NASDAQ. And then I put the NASDAQ and the NDX, which is the NASDAQ 100. Because like I talked about last week, the NASDAQ is made up of a lot of very small companies. A lot of times, a lot of those will go out of business, but it will still be reflected in the advanced decline line for the NASDAQ. Whereas the NDX is the top 100 NASDAQ stocks or the mega cap technology stocks. So you can see the difference between the two here. And this kind of shows you that those mega caps are basically carrying the NASDAQ down here. What we want to see is this to turn, either for this to start to trend back up, and you can look at divergences on something like this as well. And you can see right here where the market was going down. This is the NASDAQ was going down, and this was making higher highs, very small ones, but making higher highs right there. So that's a positive divergence. So that's the other kind of divergence we'll want to look for, is when these new lows start to move up, start to increase. New highs start to increase. When it gets above black, in the black, then we are already in an uptrend.
Right.
Okay. So that's something that's interesting. Also on the S&P, we look at this chart here. This kind of gives you just a very simple 2-year view. And again, you can see right here at 41.75, that's where the Fibonacci level is. That's where the bottom of this channel is. So that's, everything is pointing to that to be where the support level is going to be, around 41.75. And then longer term weekly, again, you can see these are the Fibonacci levels, and you can see now where they're anchored. So the high in July and the low last year, the low of the bear market.
Right.
And again, the 38.2% Fibonacci level is at 41.67. So again, right around that area is where I think the selling might get exhausted.
Okay.
And then we'll just have to see how much of a rally we get, or if we're near the end of year rally.
Okay.
Let's see. Remember breadth analysis? I showed you the small cap, mid caps.
Yep.
So the small cap and mid caps had a little rally. You know, they looked like they were going to break through the downtrend line right there, but they fell off with the rest of the market last 3 days of last week. But look at the large cap and New York Stock Exchange and NASDAQ. They also had dramatic downturns. New York Stock Exchange took out its low right there. The NDX is right at the low. The S&P is still a little bit above it. But we talked about that, you know, these drop below it much earlier. And maybe this was indicating it's going to move up the cap stack.
I remember.
So that's what it looks like now. And there's the 200-day right there.
Well, next week is going to be exciting. That's for sure.
Next week will be very interesting. Yes. The one thing that's kind of a positive here is the growth versus value. Even as the market has sold off, you can see the SPY, the S&P, and the Russell 2000 down here. You can see how they've broken their uptrend lines. But there hasn't been much rotation out of growth into value.
We're going to see what happens this week. We got a lot of growth reporting.
Right. I mean, the big traders look like, you know, they're still positioning themselves into growth. And then the last thing here is to see the Tesla effect. We talked about this on consumer discretionary. So Tesla in September had some good news. So this is the cap weighted XLY, consumer discretionary. Amazon is 25% of it. They report next week. Tesla is 20%. So just those two names is 45% of this whole ETF.
That's crazy.
All right. So when something happens with Tesla, or Amazon for that matter, it's going to have an effect on this XLY versus XLP, discretionary versus staples. And you can see the effect it had. It broke through the support line down here where the equal weighted of those two did not break through. So Tesla has a huge impact. You can see back here in September when Tesla had good news, the XLY went up, even though the equal weighted went down. So Amazon is going to be really, really important next week.
Absolutely.
All right. I think that's about everything I wanted to show today.
Very cool.
We have to be careful. It's a bad time of the year right now. Hopefully we will see a little bit of a rally next week, but it might not be till the end of next week or even into the week after. More towards the end of October.
Yeah, we get the big economic number of the week comes out on Friday, which would be PCE. Obviously, PCE core is the one the Fed talks about. So we got a lot of data this week. It's going to be interesting. What's going on with the consumer and credit cards?
Right.
It's going to be an interesting week. Dan, thank you so much.
There'll be a lot of catalysts to push the market either way.
Absolutely.
So I'm still holding my end of year rally.
You're not giving that up?
I'm not giving it up yet. In fact, I put 2 quotes in my newsletter this week about 2 other things that I subscribe to about that they said. And one of those is Stock Traders Almanac. They are still holding that the end of year rally is still coming, that this is normal. This is a normal correction for this time of year. This is a seasonal correction that typically always happens. And they're still holding out for that end of year rally. And so am I. But, sometime in second week of November, that could change.
There you go. Well, we'll keep coming back each week. And thank you for the playlist. Thank you for your hard work. And thank you for your newsletter.
You bet. If anybody wants the newsletter, just go to breakpointtrading.net and you can download it from there.
Awesome, buddy. Thank you so much.
All right. Take care.